The battle with inflation continues to take the headlines, with the latest data release showing the lowest CPI since September 2021, which reignited the hopes that the Fed will refrain from raising rates. Nonetheless, the Fed ascertained that its focus is inflation above all and raised the federal rate to 5, despite broad concerns that such a move might add more pressure on the financial sector, especially after the recent bank run. Moreover, the Federal Reserve published its newest economic projections. This data is extremely important, as it gives the market a clue on what the Fed is seeing. For instance, last year in September, the projection was for the US economy to grow by 1.2% in 2023. But in December, the Fed slashed this figure to more than half. And last week, it went even further with only 0.4%. To put it into perspective, the US economy grew by 5.7 and 2.1 in 2021 and 2022. Note, though, here that 2021 was an exceptional growth year, which followed the pandemic shutdowns. As we discussed before, somewhere on the tail end of the rate hike, there will be a sharp drop in the yield. We saw this beginning to happen when the 1-month and the 2-year treasuries dropped almost 100 basis points in less than 2 weeks, right before the Fed hike. That was due to the conviction that the Fed was going to pause their rate hike. Hence, we saw a huge inflow in money market funds. And even when the rate hike happened, yields still closed lower for the month. The equity market, on the other hand, has finally begun to factor in the current risk-free yield, and it wavered upon seeing the Federal Reserve's determination on fighting inflation above all else, even if it led to lower economic growth. Here we saw the small cap dropping to almost being flat for the year so far, while the S&P remained resilient, with tech sector pushing 18% year to date, which brought the S&P to around 5% so far, which means all the other sectors have been struggling except that one after the tremendous drop that it happened since last year.